Hey, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. It is Tuesday, June 12th, and you are tuned in to On Trend, the show that is designed to keep you on the right side of the trend. Today, we're going to go over airlines with a little tutorial on the Raff regression channel. We'll look at a mean reversion setup for oil. We'll look at some oil ETFs and stocks. Look at the big banks and XLF because they remain weaklings, and this is important because we got a big Fed meeting and that will move the bond market probably. And we'll finish with some stocks to watch. So we'll start off with airlines because they're getting a lot of chatter lately, but I don't think they are taking off just yet. The Jets ETFs remains short of a breakout, and we're going to look at that with a tutorial on the Raff regression channel. All right, so here is a basic chart of the Jets ETF, the U.S. Global Jets ETF, which has a bunch of airline stocks in it. I've got the 50-day EMA with the green dashed line, the 200-day EMA in red, and below I've got the PPO 50-200-0. And to see those settings below, there you can see the percentage price oscillator. And when you put the signal line at 0, that basically removes it, and it shows the PPO as a histogram. So we can see that the 50-day EMA is above the 200-day when that PPO is positive. And you can see as the 50-day comes towards the 200-day EMA, the PPO moves down. And then as the 50-day moves above the 200-day, further above it, you can see the PPO moves up. And I kind of use this just to gauge the overall trend for the Jets ETF. Also, when you use the PPO, you can take off the moving averages because you really don't need them. I don't think moving averages really mark support or resistance levels. I think they're just used to kind of gauge the overall trend direction. And I like a clean chart, and so that's why I'll take off these moving averages. Now, when you look at this chart, there's a couple things we can assume based on just what we're seeing here. First of all, I don't see an uptrend. Okay, the trend is flat at best. You can see we're basically at the levels we were a year ago, so we've gone nowhere. You know, we had an advance from September to January and basically a decline until May. We know that the S&P 500 SPDR has moved higher since April. It's up around 8% from that April low. And if you look at Jets, I'm going to click on that inspect button there at the top. And you can see there is that early April low in SPY, which I'll show in a minute. And you can see we're down a fraction. So Jets is underperforming. So on the face of it, I would move on from this ETF. I wouldn't even give it a second look because I'm not interested in picking bottoms and it's underperforming and it's in a flat trend. So, but I'm going to still go ahead and do some analysis. But as far as, you know, a tradable instrument, I would just move on and look for something better. Now, this is for a tutorial of the Raff regression channel because sometimes I find it hard to draw trend lines that I consider to be valid. All right, if you look here, we can draw a trend line, but it's a pretty steep trend line. And sure, it gets, you know, maybe 3 touches if we want to be liberal with that. And maybe a breakout. You know, this trend line's pretty steep, but you know, okay, of course, the break held this time, but that isn't always the case. Here's another steep trend line, and in hindsight, you know, trend lines can work great, but I think in practice, trend lines, especially angled trend lines, are very subjective, and I don't think you can really trade on them. So I'm just going to remove those, and what I'm going to do is I'm going to use the Raff regression channel. Because, you know, we have these upswings and downswings, and we can kind of get a more objective look by using the Raff regression channel because you basically draw it from the low of the move, the closing low here in November, to the closing high. All right. So this middle line is a linear regression, and these outer lines are equidistant, and they are based on the furthest high or low. All right. So I'm guessing that it's this low here, and so that sets the distance, and the other one is that distance away. And you can see when you break it there, that's a trend reversal. So then we had a downward sloping Raff channel here, and we broke out in February. And in order to keep this fairly clean, we had an upward sloping Raff channel here in February, March, and broke down. And that's the most recent downtrend. And now we can see from this high, we'll start our new Raff channel. All right. And you can see as I draw, all right, there looks like we did have a breakout, but we continued lower. So I'll continue drawing. But you can see if we go to this low here, there's the low, closing low, and there's where the channel ends, and I'll draw my resistance there. All right, and that's the level I think we need to break to get a reversal in this airline index. You can see we got that big surge in May, but we fell back. We got a surge yesterday up 1.5%, but we need some follow through to get any kind of a breakout worth its salt. Now I went to the Jets website here. There you can see it, U.S. Global ETFs, to look at the holdings. And there you can see the top holdings dominated by the two biggies, United, Delta, four biggies, Southwest, and American. And so I put these in a chart group to see how they compared to each other. And basically what you have here is you have the February low. That's the green horizontal line there. And you can see American is holding up pretty well. It's one of the stronger ones, all right, because it held above that February low in April, May here. American did not. It's one of the weaker ones, all right. Delta did, so it's one of the stronger ones. So it's United and Delta that are leading it. And then you can see Southwest broke below it. So I would stay away from American and Southwest if you're looking for something in the airline group. Now, the next chart, I added some other airline stocks in the group, and the strongest one of all seems to be SkyWest, because you can see it held above that February low. You have a triangle within an uptrend, so it looks like a bullish continuation pattern, and a breakout there would be bullish. Alaska Air, one of the weakest, and you can see Save is also weak there, and we can see JetBlue is also weak. So there's really not a lot of strength within this group. Only three have fairly decent looking charts, and we can see, of course, that SkyWest has the strongest. So I remain concerned with weakness in the finance sector and the big banks, and we're going to look at XLF and these bank charts here. So here's XLF, and we can see that there's that big falling wedge. And, you know, typically after a big advance, a falling wedge is a big correction. And we can see we got support here in that 26.5, 27 area near these retracements, 50 and 61.8%. So it's a normal pullback. The wedge is a normal pattern for a correction after a big advance. But the problem is finance is not breaking out. You had the breakout attempt here in May, but we failed. And this, of course, was the Italian election that Tuesday afterwards. We got a nice bounce back and filled the gap, but we need to get a follow-through breakout at 28.5 to put finance back on this upward trajectory and help support the bull market in the broader stock market. Now let's look at some of these individual stocks. So once again, I went to the XLF website. So I Googled XLF holdings, and there you can see the top results, sector SPDR.com. And you can see I've been to that page many times because I check the holdings often. And if you go to this page, you can see the holdings for any of these SPDRs, and there we can see the top 10 stocks. So I'm going to look at a handful of these big banks to see how they are performing on the charts, because that is what really matters. So here is XLF in the top window. We've already seen that chart. And then I've got JP Morgan and Bank of America and Citigroup in the next three windows. And there you can see these big resistance levels, April, May highs there. All right. JP Morgan didn't break above. Bank of America did not, even though they're holding support here. And we can see that Citigroup hit a lower low there. So it's not even close to a resistance challenge. And if we look at this bounce over the last week and a half or so, it's starting to look like a bear flag. And if we break down here that's going to open the door to further weakness in the finance sector. Down here we have Goldman Sachs. I mean, this is one of the weakest. Broke support there, a lower low here in late May, early June, and what looks like a bear flag. And the same thing with U.S. Bank. Trying to break out there, but failing. And look at that, was a lower low. So not a lot of strength within the finance sector among the big banks. So I wanted to compare performance of these sectors from a particular date, and that would be the date that the SPY bottomed in April. And so I've got on the inspect button up there at the top left so I can look on this chart. And there's the low on April 2nd. And if we click and hold that click down and move to the right, we can drag that over to count the number of days. And if you look over on the far left of the chart in the middle, you'll see 49 periods. And so that's kind of like our anchor date. All right, we've got this rally April, May, and into early June. And we want to see which groups are leading and which are lagging during this rally. So what I did was I created a perf chart. And this has the 9 sector SPDRs, well, 10 plus XLRE. And it goes from April 2nd to June 11th. Now, on the perf chart, you have to put 50 days. You have to add a day. But we can see that, look at finance. All right, of the major offensive sectors, consumer discretionary is up 12%, technology up 12%, industrials up a little over 5%, and then we can see healthcare up 7%. And of the major sectors, finance is the weakest. It's up only 4%. Since that April low, so it is underperforming those bigger sectors. And then we can see the weaker sectors would be consumer staples, and utilities is the weakest sector of all right now. So now let's turn to the bond market and see how that might affect banks and utilities and REITs. So we're going to look at the Treasury bond ETFs as well as Treasury yields here. And this first chart goes back 1 year, and we can see a long-term downtrend basically in Treasury bonds. This is the unadjusted IEF. I put a little underscore before the symbol there at the top left, and that removes the distributions. So you get basically a pure price chart, no dividends. And we can see that, we had the breakdown here in December. We have a resistance level established in late March, early April. And that's the resistance level to watch for the bigger downtrend. And we look at TLT, we can see that breakdown there in January, the resistance level, and we fell back from that resistance level with that peak in late May. All right, so that's the level to beat. A break above 123 in TLT would be bullish. It would reverse the downtrend in Treasury bonds, and that would be a change. We've seen Treasury bonds basically trending lower since that September high. So if we get a breakout there, that might shake up the markets a little bit. So I've got a shorter term chart of these two. And the reason I'm doing that is because there's the big surge that we had when we had a little bit of a risk off trade going on. You can see TLT surging from 116 to around 122.5. And then we fell back. And look at that, we retraced around 61.8% of that prior advance. Maybe it's a falling flag, and that's why I'm watching, because if we get a breakout there above last week's high, that argues for a challenge to resistance, and a bigger breakout there would mean that Treasury bonds are moving higher, and then Treasury yields are moving lower, and we would have to maybe rethink what we think about utilities and banks. So here's a chart for Treasury yields, and of course this looks inverse to what we saw for the IEF, the Treasury bond ETF, and the TLT, the 20-plus year Treasury bond ETF. So there we can see support at 27, which is 2.7%, and there's that little flag. So you break that flag, that's the first negative, and if you break 2.7% or 27 on this chart, that's the second negative to watch for the 10-year yield. So the reason we watch Treasury yields so closely is because they have a pretty strong positive correlation with banks and a pretty strong negative correlation with utilities and REITs. So this is a chart with the correlation coefficients, and I'm using a 13-week chart and a 13-week EMA for each correlation coefficient. So 13-period correlation coefficient in black and the 13-week EMA, just to smooth it out. We don't time market moves with correlations. They just kind of give us a broad brushstroke idea of how two symbols, two assets are related, how they respond to each other. Now, correlation is not always causation, but I think in the case of Treasury yields and banks and Treasury yields and utilities are pretty strong cause and effect working there. So we can see that, Treasury yields have been rising there since that summer low, and there's a positive correlation with banks. So if Treasury yields continue to rise, that's going to be bullish for banks. And you can see as long as Treasury yields rise, they have a negative correlation with utilities. And so that means utilities have downward pressure when Treasury yields rise. And that's why if Treasury yields turn down and break that 2.7% level, then that could be negative for banks because they're going to move in the same direction as Treasury yields. And it could be positive for utilities because they're going to move in the opposite direction. So that's why this week we need to watch Treasury yields. All right, now we're going to move to oil because we have a classic mean reversion setup working in West Texas Intermediate and USO. So this first chart here is going to be West Texas Intermediate, and I like to use West Texas Intermediate for my long-term assessment of crude oil. I don't like to use USO for the long term. If you wonder why, look at a 3-year chart of USO and a 3-year chart of West Texas Intermediate. Compare the performance, compare the highs and lows, and you'll see that WTI is the better one to use for the long term. But clearly we don't need much here because this is an uptrend here, a long-term uptrend. And you can see we've had sharp pullbacks along the way, and there is RSI moving below 30 and back above 30 in February. We had another sharp pullback now, and there's RSI moving below 30 and above 30 here in early June. So that's why we have a potential mean reversion set up, which means you have this long-term uptrend. You've pulled back within the uptrend, short-term downtrend. You've become short-term oversold, and now we could get an oversold bounce and a continuation of that bigger uptrend in oil. Keep in mind, when you're looking for mean reversion trades, you want to be trading in the direction of the bigger trend, which means if the bigger trend is up, you want to look for pullbacks or bullish setups or short-term oversold conditions. Now, when it comes to USO, I can use the short-term chart. And when I short-term, I mean, 6 months or so. But there we can see the breakout and the move to new highs. And then we have this pullback, and we're firming kind of near this breakout zone. And there's the 50 to 62% retracement zone. So this is an area that could give way to a bounce in oil. And oil is already starting to firm. And there you can see RSI moving from oversold levels. So this is when we need to be on guard for a potential bounce in crude. All right, now we're going to turn to some crude oil or energy-related ETFs and stocks. So the first one up is going to be XLE, which is the energy SPDR. The two dominant stocks there, ExxonMobil and Chevron. Third, a distant third, would be Schlumberger. But if we look at the chart here, we can see, first of all, I think the long-term trend is up. So that is important information. There's a 52-week high there. We had that breakout there in April. We had a flag consolidation, a breakout there. Then we had a throwback to the breakout zone. And now we're bouncing. And you can see we had a gap here in late May, and we have a gap 3 days ago in early June. So it looks like XLE is trying to move higher, and that would support the bounce in oil that we're possibly seeing. Next up, we have XES, which is kind of like XLE on steroids. It's a more volatile ETF, and it tends to be higher correlation to oil, the oil price. But if we look on this chart, we can see, a big move up, 14 to 19. That's over 20%. And you had a consolidation here. And so we've fallen back to this consolidation, and now we're getting support. And we also have this 50% retracement here. So we have like 2 steps forward, 1 step backward, and we're trying to firm. And if we can get a breakout there at 17.7, I think that's going to be bullish for XES. Now you need to watch oil too for an upturn as well. Now there's RSI in the indicator window, and ideally RSI would go below 30 to give us an oversold reading and then bounce back above 30 for that mean reversion setup. But we know the markets are not always ideal. So sometimes we have to use an oversold zone. So when RSI moves into that 30 to 40 zone, it's kind of getting into that oversold area, and we need to be on higher alert for a potential bounce. And so we've gotten there twice. And so this is when we need to be on alert for a bounce, and that's why I'm watching XES closely. Now, as far as some stocks, I've got Chevron here, which is got a gap up, kind of like XLE, the breakout, the pullback, and now we got that gap up. As long as that gap holds, I would expect Chevron to continue higher. We've got Schlumberger here, similar situation. You can see it had a deeper pullback there, but it's hitting, that zone. There's a lot of congestion here and a lot of support, and it looks like it's trying to turn up here, and got a little gap there 3 days ago as well. And one of the surprisers is the AMLP ETF. All right, it got the wedge breakout there, very sharp pullback to the breakout zone, but then rallied right back, kind of consolidated for 4 days and turned up again. So MLPs appear to be moving back in favor. All right, now we've got 10 or so stocks for you to watch. Now, before we look at these individual stocks, just a note about the general market environment. All right, I'm still bullish on the broader stock market. You have small caps hitting new highs. You have QQQ hitting a new high this month as well. We have SPY breaking out of its triangle and in a pretty decent move since early April. Now, I mentioned that early April low in SPY on April 2nd, and I showed the sector chart and the performance of the sector SPDRs over the last 49 trading days since April 2nd, as you can see here. So now I've got a perf chart with some of the major index ETFs. All right, and you can see that, SPY is up 8%, QQQ is up 12.5%, the Russell 2000 is up 12.5%, and the small cap iShares IJR is up almost 14%. So these are some very, very big moves in a short period of time, basically 10 weeks. And so that tells me that the market is getting a little bit frothy short term. I don't want to call a market top, definitely. And overbought is probably one of the most overused terms ever, because overbought is really a sign of strength. It's not a sign of weakness, because it takes strong buying pressure to actually become overbought. So, but what I'm saying is we might need a little bit of time to digest these moves, to consolidate or maybe even correct a little bit. So that's what I'm seeing, is a bit of frothiness out there. All right, so first I'm going to do an update to something that we had last week. That would be palladium, because it got a breakout. It was featured last week. We showed the breakout in copper as well. And you can see first there's the wedge break, and then we pull back to the breakout zone and consolidated here, and now we're getting a breakout in palladium. So that points to some strength in industrial metals. And there's the palladium ETF, PALL, getting a breakout as well. Next up, we have a couple of industrial stocks. This is Honeywell. And Honeywell was a big leader from 2017 into 2018, massive advance. And so it got this big correction in the form of a falling wedge. And you can see we got support here in that 138, 140 area twice. And we broke above that prior high, that intermittent high. So you have a bit of a double bottom, and you have a break above the wedge line there. So it looks like Honeywell is turning the corner here. And after that big surge in May, we had a pennant form, which is a small consolidation or rest. And now we're breaking out of that pennant. So Honeywell is looking positive here. Here's United Technologies, and we have a similar pattern working here. There seems to be a positive correlation here. There's the wedge. There's the wedge line break in the prior high, a smaller wedge, and a breakout there for United Technologies. CSCO has caught my eye because A, it hit a 52-week high. All right. B, the 50-day is above the 200-day. And C, the rising 200-day is well below price. Price is above the 200-day. So we got this gap down after earnings, I believe, but we still have the potential for higher lows here, and CSCO is firming. And we got that little breakout last week. So I'm watching to see if CSCO can continue higher. And there you can see we just became oversold there at the end of May when RSI touched 30. Next up, we have Proofpoint, which is part of the cybersecurity ETF, and it had a big breakout there in the beginning of the year. And it didn't correct. When the market corrected, Proofpoint continued to work its way higher. That's a positive sign. So we had this little wedge, and now we're breaking out of the wedge, and so it looks like Proofpoint wants to head higher and record another new high. Next up, we have Global Payments, and this is an example of a consolidation breakout, clearly an uptrend and a 52-week high. And then we had this consolidation in the form of a triangle, and now we're breaking out of that consolidation, and that signals a continuation higher. Motorola Solutions is looking kind of like Global Payments in that you have a clear long-term uptrend with a 52-week high. You have a consolidation, it's a smaller triangle, and then we have the triangle breakout. So a clear leader here, Motorola Solutions. Next up, we have Synopsys, and this is a semiconductor stock. And there you can see the wedge and the nice wedge breakout, a little flag after the breakout, and now we're breaking out of the flag. So it looks like Synopsys wants to continue its uptrend. You can put support there at 87. All right, so that's all we have time for today. If you have any questions, comments, or feedback, you can always send an email to askarthur@stockcharts.com. I can't answer everything, but I do promise to read your emails, and I will try to work in the answer in a future show. So that concludes this edition of On Trend. Thanks very much for tuning in, and remember to stay on the right side of the trend.
Volatility is back, interest rates are rising, and the markets are headed into uncharted waters. As uncertainty grows and the tides begin to change, you need to take action. ChartCon 2018 is here just in time, with an all-star cast of investing experts and industry-leading technicians. Watch live as these pros share their charting wisdom and guide you through their strategies for finding success in any market. Your registration includes 2 days of insightful, exclusive presentations from 15 investing legends, plus complete video recordings to watch on demand for years to come. Stream ChartCon live right from the comfort of your own home or office. No need to travel, no need to break the bank. See how the experts are protecting themselves from market volatility and reducing risk in today's uncharted waters. Join us at ChartCon 2018, streaming live August 10th and 11th.